Hi, this is Jason, Chief Technical Analyst with Toro Alerts, with your weekly market recap for the week ending November 11th. We saw a pretty mixed set of news this last week, as we ultimately saw some pretty terrible news in the crypto space, but we also saw a lot of bullish momentum in the traditional market. So let's dive into the charts and take a look at what they're telling us. Starting out with the Bitcoin chart. So Bitcoin, as I said, was doing pretty well before the FTX blow up, and we were trading almost at about 21K, and I think we were actually poised for a potential bear market bounce in crypto, especially with that dollar rolling over, as we tend to get some inverse correlation between the dollar and the crypto asset class. However, that FTX blow up ultimately was a much more significant event, and it ultimately sent all cryptos quite a bit lower. We saw Bitcoin ultimately getting all the way down to about 15,650 before seeing a decent rally the next day, but then a lot of that rally has been since given up. We're currently looking at Bitcoin on November 13th while I'm recording this, sitting at about just below 16.4, and I'm definitely staying bearish, and I'm actually shorting Bitcoin at the moment. As soon as we lost that anchored VWAP position at the 17,900 level, I went short Bitcoin, and as long as we stay below those levels, then I'll be staying short Bitcoin until we find some support at some lower price levels. And those price levels I'll be watching for. First one's right around 14K, about 13,900. And if we lose support there and head lower, then I'll be looking for about 12K for the next area of support, which is right around this anchored VWAP position, which is currently sitting about 11,800. And so that FTX blow up definitely put a big shockwave into the crypto markets, and ultimately I think ended what could have been a decent little rally for us, just based off of that inverse correlation to the dollar drop. But yeah, right now with the FTX concerns, and I think there's a lot of people wondering whether there'd be contagion around that event, or if there's other crypto brokers that are maybe playing with some leverage that we don't know about yet, and that could ultimately cascade in some other crypto brokerage companies potentially getting exposed through these bear markets. That's typically what happens when we have a bear market, is people that are doing things that they shouldn't get exposed, and they ultimately get flushed out of the system. And so long term, I think it's ultimately a good thing for the crypto asset class space. I think it's going to fast track cryptocurrency regulations. But obviously, if you're an FTX investor, trader, or using their brokerage platform, it was a pretty bad situation. Same with the Terra Luna event a couple of months ago. So definitely make sure, if you are trading or investing in crypto, make sure you've got a reputable broker. If you're just investing and holding it, then having your own crypto keys is even better, because then you're not sitting on a brokerage crypto broker whatsoever. As a trader, like myself, you really kind of need to have that brokerage so you can have quick access to trade in and out of your crypto coins. But I'm definitely sticking with the ones that have a lot more security and have different regulations. There are different crypto brokers out there that are exhibiting that they are at least trying to do things the right way. They're already getting certain regulation check marks done ahead of the actual crypto regulations that will require it. And so do your due diligence on any crypto brokers that you're using, because definitely do not want to get stuck in a situation like the FTX or the Terra Luna crowd. But as far as Bitcoin goes, again, looking for that downside target of 14K or about 12K for the two downside areas of support that I'll potentially be looking to close my short out of. But I think longer term, I still think there's a chance that we get potentially even below that 12K. But I think at 12K would be, I think, the best case scenario for a potential bottom on Bitcoin. And when we take a look at Ethereum's actually held up a little bit better from the collapse. It actually sold off pretty aggressively, but ultimately that brief rally we had for one day, it's held up a lot better than Bitcoin has and a lot of the other crypto coins. It's currently sitting at this area of support, which is sitting about 1,225, and that is an area that has been a pretty strong area of support for quite some time. A lot of volume support behind it, and it's been kind of this trading channel we've been in until we broke out to the upside, and then ultimately had that huge failure after the FTX blowout. So I think the Ethereum chart, I think, even shows it even better, that we likely would have broke that 200-day moving average and potentially headed even higher on Ethereum had that FTX blow up not happened. But it did, and so because it did, it definitely changed the dynamics of the crypto space in the short term, and it definitely got me pretty bearish across the whole asset class for the time being. If we see Ethereum lose that 1225 level, then we'd be looking for some potential downside support right around 1100 like it found before. And if we lose 1100 on Ethereum, the next downside target I'd be looking at would be just below 900, which is our next anchored VWAP position, which is sitting at about 881 currently. So let's dive over to the traditional markets. The S&P 500 had a much better week than the crypto asset class space, and we saw that across all the major indices. We've seen a very strong rally materializing in the traditional markets, and I think there's a good chance that continues. But we do have some areas of resistance coming up fairly soon, especially if this rally continues into next week, that we'll need to watch for. The first ones being the 200-day moving average, which is currently sitting at about 407 on the SPY. That would be an area of resistance to watch for, and then once we get above that, assuming we do, then the next bigger area I would argue of support would be this trend line at the top here. We've ultimately hit the top of this trend line 3 times since the start of the sell-off in the S&P, going all the way back into January of this year. And each time we've reached that level, it's sold off pretty aggressively. So that'll be a really key area to watch for. I do think there's actually a decent chance we might break through this time, and if we do, then I think that'd be pretty bullish for the markets, depending on the timing of when we get up to those levels. If we do, there's also quite a bit of volume support, and we've also got a Fibonacci extension area that could act as resistance right around the 414 level. So there's definitely some multiple points of resistance that the S&P is going to have to do some work to get above. But if we ultimately see it break above those, and I think that'll be pretty bullish, and I think that'll probably shock quite a people, which would probably get a lot more people getting into the market at that point, and we might actually see a much bigger rally than most people are expecting. And that's kind of really what my base case at this point is, that I think there's a decent chance that we actually do have a rally much stronger than most people expect, and that'll set us up, but hopefully for a nice year-end rally, so that we can hopefully, as traders, get some nice upside profit before the end of the year. So that's certainly what I'm looking for in the markets and on the S&P 500. And then when we take a look at our breadth measures for the S&P 500, we can see in this top channel here, the 200-day moving average, we've got 55.6% of S&P 500 stocks above their 200-day moving average now. We can see that that's actually already higher than the last rally we had. It started in June and ultimately failed right around the 50% level. And so that's a pretty bullish signal right there, I think, for the S&P 500 to see that on a relative basis, and looking at terms of breadth, that we've got a stronger rally already in this rally than we did in the last one. And so I think that's a pretty bullish sign. And when we look at the percentages of S&P 500 stocks above their 50-day moving average, we can see that continues to rise up, and we're sitting at about 82%. Not quite at the level that some of the stocks had reached before, but still a pretty bullish-looking breadth measures across the board for the S&P 500. And then we take a look at our triple Qs, the NASDAQ. It's also had a pretty good rally, but it has been one of the worst performing sectors on the year. So we might see a decent bear market bounce out of this one, but it's still probably my least favorite sector longer term. But there could be some nice upside opportunities. We saw in the S&P 500, we were pretty close to the 200-day moving average and that top trend line. When we take a look at the NASDAQ, we can see that we're not anywhere near it really in relative terms compared to the S&P 500. So there is a decent chance that we continue to see a rally out of the NASDAQ for the time being. But this chart, I'm a little less optimistic about seeing a real large sustained breakout above this trend line and getting well above the 200-day moving average. But we'll see how it goes. We still need to get above that trend line and that 200-day moving average, and we'll see where it goes from there and see how the price action's looking. But for now, across all indices, things are looking pretty good, and this rally looks like it might have some legs to it. When we jump over to the Dow Jones Industrial Average, that one has actually done very well. We're already above the 200-day moving average, and we're also above any of our trend lines. We had the more established trend line that had multiple touches on it when we saw the sell-off in the Dow Jones Industrial Average, and then we also put another trend line up that was parallel to that one from the breakout from the last June rally, and we've blown right through that as well. And so the Dow Jones Industrial Average is looking really strong on a relative basis, and we are coming up against a Fibonacci extension level at about 342.50, and so that would be an area of resistance to watch for, and maybe an area that makes sense where it might pause or have a bit of a correction. And we'll see if we can see even stronger performance out of the Dow Jones Industrial Average going forward. But it's definitely looking pretty strong, and has definitely been outperforming the NASDAQ. And when we take a look at our Dow Jones Transportation Index, we had some pretty interesting developments on this one as we got back up above this Fibonacci extension level, and we're also just above that 50-week moving average, just barely, but we're just above that, and we ultimately hit the top of our trend line that has ultimately acted as resistance 3 other times this year. And so next week will be really interesting to see if we can get above that level. Obviously, if we see some price action above that trend line, then I think that'd be very bullish for the transportation sector, because we'd ultimately be above all the major moving averages. We'd be above Fibonacci extension level, which would be a great area of support to trade around. And if we see that breakout above that down channel trend line, all of that would look really bullish for the transportation sector. And then taking a look at a Russell 3000 chart, this chart here, we're really going to be looking at this convergence area potentially at that yellow center line, as well as this down channel trend line that we've been monitoring for quite some time. That also looks like it's going to coincide pretty tightly with the 50-week moving average. And so really we've got 3 major kind of areas of support and resistance that we look like will likely be testing on the Russell 3000, and will be real interesting to see where we go from there once we hit those levels. Certainly if we got above that center channel trend line, broke out of this down channel trend line that we've been resisting against, and got back up above that 50-week moving average as well, I think all of that would be really bullish for the stock market abroad, and we'll be keeping a close eye on that one, as I think that'd be a pretty bullish signal if we see price action get back up above those levels, because we ultimately haven't been able to get above the 50-week or that down channel trend line for quite some time. The last time we were above the 50-week on the Russell 3000 was going all the way back into March of this year, so it's been quite some time where we've been below those levels, so that would definitely be an interesting development if that occurs. And then taking a look at our Russell 1000, our large caps, we did get above our 150-week moving average, and that's certainly bullish, as we got up against that level a couple of times and ultimately failed off of those levels. And so the next area that I'll be watching for on the Russell 1000 for our large caps is our Fibonacci extension, which is sitting at about 231.30, which also coincides with our 50-week moving average. And so obviously we can get above that moving average and that Fibonacci extension. That'd be extremely bullish for the large caps, but that 231.32 level is going to be a real key area of resistance that I'll be watching for to see if we can actually break out above that for our large caps. And then taking a look at our small caps, or Russell 2000, we got up above our 200-week moving average pretty decisively this week, and ultimately found resistance at this anchor VWAP from the COVID lows, which is sitting at about 186.83. We ultimately closed up just slightly above it, so we technically got just above it, but only by a matter of a few pennies. So we'll see what happens going into next week for the small caps. It would make some sense to maybe see a pause at this level, so maybe we see a bit of some selling in the small caps going into next week. But obviously if we can get above that anchor VWAP, as well as that 50-week moving average, it's getting pretty close to converging with that VWAP area, then that would certainly be bullish for our small caps. And then take a look at our value versus growth. Value has definitely been the winner on the year, as we've seen value outperform growth. But this last week we did see growth have a pretty strong week compared to value, and I think that ultimately was just because growth has been so beaten up that a lot of times you'll see some pretty big outperforming weeks on the weaker sector in a larger trend, because they've been beat up so aggressively. And so we'll see what happens there. We obviously have a down channel trend line, a second one, that we'll be watching closely, where we've ultimately found some resistance. So we'll see if we can get above that. If we saw a break above this down channel trend line, then I think that would be a bit more bullish for the growth sector. But for now, it's still looking like value is a much better place to be than growth. And then let's take a look at our sectors that we monitor. So this is all of the sectors that we track over the last 5 trading days, so for the last trading week. And we can see at the leaderboard at the top, cloud computing had a huge week, up almost 16%. I mean, that's a sector up almost 16% in 1 week. That's a pretty massive move. Semiconductors also up 15.5% on the week. Arc Innovation having a huge week, up almost 15%. Gold miners really starting to move, up 13.5%. Online retail up 12.5%, as well as home builders up 12%. Arc FinTech Innovation up 11%. Global auto fund up 10, as well as the technology sector up 10. So a lot of sectors up over double digits in 1 week. So very, very strong rally that we saw across just about all sectors. So really all the sectors we're tracking are green except for two. And when we go down to the bottom here, we can see Nat Gas is at the bottom of the leaderboard here, down 8% on the week. And then we saw the Ag Fund ultimately flat on the week. But every other sector we track was green on the week, and it's interesting too to see that some of the more defensive sectors like healthcare and utilities are at the bottom here at about 1.5% and 1.8% each as well. So definitely looking like we've got a lot of broad-based participation in this rally, and I think there's definitely some legs to this thing, and we can continue to head higher going forward. And then jumping over to our U.S. oil chart. So oil has been something that I've been tracking really closely, especially after we broke out of this down channel trend line, that I was really looking to find a bottom in oil after we ultimately peaked up at about 124 a barrel and then saw a pretty steady decline from there. Well, we've definitely broken that trend, and it looks like we're heading higher. As long as we're above 85 a barrel on U.S. oil barrels, I think we've got to be pretty bullish in the sector. I think there's also a lot of potential for energy to take off, as I don't think we're going to see a lot of SPR reserve releases going forward now that the election cycle is winding down. And so I think there's a good chance that we'll see higher oil prices, which makes me very bullish on the energy sector. And I already have quite a few trades on in the energy space, but I think that those trades are just going to continue to pile up, and we're just going to continue to see some more opportunities in the energy space. And energy is one of my favorite sectors going forward. I think energy will be one of the few sectors that has a potential to continue going up when this broader base rally ultimately dies out. And then take a look at our CRB index for our commodities. We saw a little bit of a down week on commodities. It actually had a bigger sell-off, but ultimately hit that 50-week moving average and then bounced off of that pretty aggressively. So I'd actually say that looks pretty bullish for the commodity space and for our CRB index, especially since we broke this down channel trend line, and now it looks like we're trying to get back up into this upper area where we've been kind of hanging out at and heading higher for most of both really a couple years now. This is since the COVID crash. Really, we've had a pretty consistent rally in commodities after this correction. So the big question is, do we see another ripper in commodities, or is this still in somewhat of a corrective phase and we're just going to ultimately see commodities head lower? I think for most of us tired of inflation, I think we're rooting for commodities to go a little bit lower. But right now, as long as we're above that 50-week moving average, it's pretty hard to be super bearish on commodities. Then taking a look at our all-world ex-US index, so this is global markets minus the United States. Saw a pretty major development on this one this week as we broke trendline support that has been in place since really the sell-off started. So going all the way back to January of this year, we've touched this trend line many times, and every time we did, it was ultimately the signal that it was going to correct, and each time it's been very reliable. So we've come up here multiple times and had a pretty aggressive sell-off from there. But this week we had a pretty big break above that. We didn't just get a little bit above it, we got a lot above it, and that's definitely looking fairly bullish for the global markets right now. Some of that might have to do with the dollar rolling over. If we got a big sell-off in the dollar like we did this week, that's certainly going to support global markets better. So we'll see if that continues, or if it was just more of a rally supported by a dollar decline. But that's certainly a lot more bullish looking than it's been, I would say, all of 2022 for the global markets right now. So definitely an interesting development, something that I'll be keeping a close eye on. As far as support resistance levels, that 5220 level would be our upside area of resistance to watch for, and then if we see it correct, that 4750 looks like really strong support. And then take a look at our high yield corporate bond chart. It looks like we are trying to get up and retest the 7511 level. We haven't quite got there yet, but we'll see if we can get back up above those levels. If we get above the 7511, then we'd be maybe looking for some resistance either at that 50-week moving average or the 7950, which is another area of support and resistance. But this HYG, our high yield corporate bond index, has been a pretty strong indicator when this is going down. Usually the markets are going down, and when this is starting to head back up, usually it's either showing that we've got a bear market bounce or that we're seeing a rally in the markets. And so this definitely is supporting what we're seeing as far as a stock market rally. And then take a look at our precious metals. Gold's had a pretty interesting couple of weeks. So 2 weeks ago, we got up against this trend line and ultimately hit that and resisted off of that level. But then the very next week, we ultimately opened just above that trend line and then just rocketed up higher. We saw, a really large move. This is a weekly candlestick, and we can see just scrolling back through time. This is just charts showing us all the way back to 2020, and there's not a lot of weeks in gold where we had this strong of a move. So that's definitely an interesting move to see out of gold, as well as we're seeing this trend line break. And so what this is sort of making me think is maybe the tops in the markets, tops in the rates are potentially in. Gold typically is inversely correlated to the 10-year interest rates, and so when interest rates are going up, gold's typically going down. And we can see that while we had a nice gold rally at the beginning of the year, it ultimately started heading lower in March and has done nothing but head lower since then. And then we've started to see a rally these last couple of weeks, and a pretty substantial one that's been supported by the 10-year ultimately topping out, at least in the short term. So it'll be interesting to see if maybe the gold is giving us a clue that while I don't think rate hikes are done, that maybe we're getting a lot closer to the top of the rates than people think. And ultimately, once we do know rates are done, then I think that's going to support a really strong gold rally. We might already be seeing the start of that. So if you're a gold buyer and you're looking for some trading opportunities, it's starting to look pretty good. If you're not in gold right now, though, I would throw some caution out there as far as some areas of resistance that we're pretty close to. Looks like about 166, 167. There's some pretty major volume resistance that we need to get through, which also has multiple moving averages right around that level as well, which oftentimes moving averages typically can act as support and resistance. So I'd probably be looking for GLD to get above about 168 or so, which would likely get it above all our major moving averages. And if we see price action stay above there, then I think that'd be a really bullish sign for gold. If you're already in it or you're looking to get into it, I think it's looking like there's a start of a trade here. But since I didn't get into gold quite yet, I'll be looking for that price action to get above those moving averages and that volume resistance first. But things are starting to look pretty interesting in the precious metal space. And looking at silver, also looking very interesting. Had a massive rally 2 weeks ago. Lesser rally this last week, but still a good rally nonetheless. And so we've seen a couple of really strong weeks out of silver, and we're ultimately hit that 50-week moving average, and that so far has acted as resistance. So with silver, I want to see price action get above those moving averages, and if we can continue to see silver rise and get above all of those moving averages, then that could signal that we got a new bull market rally in both gold and silver. But things are definitely starting to look pretty interesting in the precious metal space, as they've been pretty much garbage all of 2022 so far. And then taking a look at our interest rates. So our US 2-year ultimately went down quite a bit, ultimately settling out at about 4.35% on the week. And then we saw our 10-year drop pretty significantly as well. It did go back up and retest the top end of the range. We've got some resistance at about 4.28%, but then it ultimately sold off pretty aggressively and sold off all the way down to 3.85%. So as long as we're sitting below 4% on the 10-year, I think it's pretty hard to stay super bullish on that. And there's, like I said, when I was talking about the precious metals, there's a chance that print we put in, looks like it was back in the middle of October, we got almost to about 4.4% on the 10-year. So I'm starting to wonder whether that might potentially be the ultimate top in the 10-year. I think there's a decent chance that it could be, but we might also see one more little bump to the upside depending on what the Fed does, of course, going in the next few Fed meeting appointments coming up. So we'll see what they have to say in December, but it's definitely looking like we're getting pretty close to the top in rates if we haven't already potentially put the tops in. And then take a look at our 30-year. We ultimately closed the week out just above 4%, so we'll see if that 4% level holds going into next week. And then jumping over to our volatility index, our VIX, we saw one brief spike in the VIX, but that ultimately sold off pretty aggressively, and now we're back below our trend line, and it looks like there's a good chance that we're heading all the way down to about 20 or so on the VIX. Once we get down to that 20 level, we'll have to keep a close eye on it and see where the VIX goes from here. Last time we hit the 20 level, we got a little bit lower than that. Looks like we got down to almost about 19 or so on the VIX, chopped around there for a few days, and then ultimately the VIX really shot up, and that was essentially when the market rally ultimately kind of died out as well. So definitely keeping a close eye on the VIX going forward, but so far we're at some pretty low volatility levels, levels we haven't seen going all the way back to about August or so of this year. So definitely looking pretty good in the short term on the VIX. And then our put call ratio also looking really good. We have been spending a ton of time above the 1 level on this chart, which is ultimately elevated put buying protection, and now we're closing this last week out at about 0.75, which is some of the lowest levels we've been at for quite some time. If we look at 2022 as a year as a whole, it's been pretty rare that we've seen levels below 0.7 on this put call ratio. And while we're not there yet, we are pretty close to those levels, and so we are at one of the lowest put call ratio levels that we've seen on the calendar year. We obviously had a pretty big drop, looks like back in March and April, end of March, early April. But other than that, we're heading towards some pretty lower levels of put buying protection because people are obviously seeing this rally materialize, and I think people are starting to believe that it might have a little bit of legs to it. So looking pretty good there. And then taking a look at our dollar chart, definitely some major developments in our DXY this week. So we've talked about this trend line to the upside. We ultimately started drawing these lines back in January of this year, and we've seen nothing but the DXY go up and up and up, staying in and respecting these trend lines both on the bottom and the top side of things. And then of course this week we saw a pretty massive break out of that trend, so that's a pretty major development. This is the first time the dollar has been below that trend line for the entire year of 2022. And it didn't just sort of get down there. I mean, it really dropped, and it dropped fast. And so we saw a 3.5% drop in the dollar in just 2 days, which is a massive move on the dollar. And ultimately found some support right around that 106.50 level, which is our 61% retracement of the last move to the upside. So that's an area that I'm actually looking at for some potential support. So it wouldn't surprise me if the dollar drop is potentially done for now. If we do see the dollar drop a little bit further, I'll be looking at that 105 level, which coincides with the 200-day moving average. And I think that's an interesting area of support if this current area of support doesn't hold. But I do think the dollar is pretty close to done to correcting for the time being. I'm not totally convinced the dollar is put in a high on this cycle yet. And some people are starting to think that maybe that's a possibility. And while it's certainly a possibility, my bet is that there's still probably one more move to the upside on the dollar, and I'll be watching for that. But ultimately, if we saw some price action drop below the 105 and the 200-day moving average and stay below there, then I might start to change my ideas about that. But for now, I still think there's a decent chance that we've got one more leg higher going forward in the dollar. And then we'll go ahead and close out the week talking about our yield curve. So while everything we looked at least in the traditional markets, are looking pretty bullish in the short term, I think these two charts are a great reminder of what's likely to come. And we're looking at in the top panel here, we've got the 10-year minus the 2-year, which is one yield curve chart that people like to refer to. And then another one that people like to reference is the 10-year minus the 3-month. And so regardless of which yield curve is your favorite, they're both inverted, they're both negative, and the 10 minus the 3 actually went even quite a bit more negative this week, down at negative 0.25, and our 10s minus 2s is at historic lows, close to negative 0.5 on that one. And so I think both of these charts are just a really strong reminder that going forward, while this rally has been a great one to trade and go long on some stocks that have been beat up this year, and I do think there's some more upside left in this rally. I ultimately still think that there's going to be some more pain in the markets in the fairly near future, and so just make sure whatever you're doing in the markets, you've got a trading plan or investment plan, and you know when to get in out of things, because I don't think this is the start of a new massive bull market rally that's going to ultimately last for years. I think this is ultimately one more leg higher before quite a bit of pain, and I think these yield curve charts are essentially warning us of that. So definitely make sure to keep an eye out on the markets, and make sure to tune in to all of our social media content. And you can download the Toro Alerts app on the App Store. We've got one for stocks and one for crypto. Give this video a like and a share, and we'll see you next time.